Welcome to the Green Century Funds webinar, The Future of Sustainable Investing. I'm Leslie Samuelrich, President of the Green Century Funds, and your moderator for today. Green Century has been a leader in the environmentally responsible field for more than 30 years and is one of the first families of fossil fuel-free mutual funds. Joining me today are two leaders in the field, Jon Hale, formerly head of global sustainability at Morningstar, and Emily Lawrence, Director of Sustainable Investing for Client Engagement in North America at Northern Trust. Welcome and thank you. Before we dive in, I just have one housekeeping rule, which is in the Q&A box. You can put in your questions at any time during the presentation. If appropriate, we'll weave them into as we're talking, and if not, we'll answer them at the end. So today's topic is sustainable investing and the future of it. And we're attempting to help you, if you're an individual or if you're a financial advisor, learn more about it, be better prepared, and address it more in the future. So while sustainable investing has been around for about 40 years, the attention it's received, mostly positive, but some negative, in the last 5 to 10 years has substantially increased. And we're in a period of really rapid change. One of the changes we've seen is the different names that the field and the investment strategies have been called. And I wanted to start our discussion there. The acronyms such as SRI or ESG abound, and the various names, ESG, impact investing, sustainable investing, positive screens, can be really confusing. Especially since there's no regulated definitions and each firm can use those terms in the way that they define them. So let's jump in first with Emily. What do you use at Northern Trust and what do you see being used in the field?
I'm glad we're rooting our conversation in the lexicon first, because I totally agree with you. When I have a conversation with an investor, we might be talking about the same thing, but we are talking in circles sometimes. At Northern Trust Asset Management, our philosophy is that material ESG issues are pre-financial indicators. If companies are positioned to manage them well, they can be positioned for long-term sustainable growth. If companies aren't managing them effectively, they can be positioned for financial or reputational risk. So our platform intentionally is called sustainable. We use the terminology ESG, or environmental, social, and governance, when we're talking about the data. But we do try to start every conversation with a little bit of a level set on our definitions and what we're talking about, so that we can make sure that we're having a really fruitful conversation.
That's great. Jon, how about you? What do you think about the definitions? Do they matter? How do you see them evolving?
Yeah, Leslie, I think the one, really important thing to keep in mind, given that there are all these various terms, responsible, sustainable, ESG, impact, when they are used to describe investment strategies or are used in the names of funds, what they do all have in common is that they're all being used to describe investments that somehow take into consideration more than simply profitability. So, as you've done at Green Century, and Emily's just done in her explanation, I think it's really important for asset managers, fund companies, but also wealth managers and advisors to define what they mean by whichever term they're using. I guess on balance, prefer sustainable investing as well. But, there are many variations beyond just that broad definition of these terms that I gave, referring to investments that take into consideration, more than what traditional investments do. So actually, I think that's one evolution that we're already seeing, is more attention being paid to okay, this is what we mean as an asset manager or a fund manager by whether it's sustainable or ESG or green or anything like that. I don't know. I guess the other thing I'd say is that on the one hand, I think the ESG as a term has probably been a bit overused. It's used to describe a pretty wide range of strategies and approaches. I think it's been embraced by the more sort of traditional fund industry as kind of an easy to use set of initials, literally easy to squeeze into a fund name. And of course, I think it's been a useful term because it doesn't have a kind of inherent meaning or understanding of these three letters that the political right's been able to kind of use it to criticize the entire field of, sustainable, responsible investing. So I think we may see less use of it as a descriptive term, both because of that and because, I think more and more fund managers, asset managers will want to better describe exactly what it is that they're doing in this area. On the other hand, I think corporations, it's interesting to me, have embraced the term ESG to describe their efforts, increasing efforts, I think, to address issues involving, environmental impact, climate risk, workplace policies, adding diversity and sustainability expertise to their boards. So, it may be on the rise on the corporate side.
Right. We've seen that on the corporate side too, that they are not shying away from using it. I also have seen and looked at other firms who some seem to be scrubbing the acronym off their websites because of the controversy around it. I know at Green Century, we really focus on talking about ESG, as Emily mentioned, just as the data, and that the data can help increase, may help increase performance if applied correctly, and might reduce risk. And then we really separate out the environmentally responsible to talk about the screening. It seems like the term ESG sort of arose in reaction to being like, we're the new players in town around doing this. We're doing with data, and almost poo-pooed screening and that values-based alignment before. One of the things that I was going to talk about, I wanted to ask you about also, is just what do ESG ratings do and what they don't do? To Emily, I know this, do you have a thought on that?
I think it's a good idea to talk about some of the limitations in the data, because there certainly are a variety of them. The first limitation here, I think to your point, Leslie, is being really intentional about the language that we're using. So exclusionary approaches that are focused on identifying companies that are violators of an international norm or sanction, companies that are involved in a business line that are concerning, that are removed from consideration. ESG data, it's a big tent. And in our definition, it's looking at anything that could be materially impactful. So I mentioned pre-financial indicators. Those exclusions are more of the values alignment approach. The ESG data, in our view, is more focused on how are companies positioned to manage material risks that are environmental, social, or corporate governance in nature that fall outside of those traditional financial metrics, so extra financial or pre-financial, as a means of building a portfolio that's more potentially resilient to risks down the line. So as we're thinking about issues related to biodiversity and water runoff, how are companies managing their effluents and waste? Are they positioning themselves to potentially have concerns from a regulatory perspective, from a community relations perspective, from a health and safety perspective? So it's a bit more forward-looking in nature and really around sort of the resilience of the business to these emerging concerns. But the data certainly there it's come a long way, but it's still a little bit Swiss cheese. There's a lot of holes out there. And part of that is because there aren't as such sort of formal required mandatory reporting across different jurisdictions. that would allow investors to make more sort of apples to apples comparisons, if you will, on some of these metrics.
Right. The one final point before I move on is that what is surprising to a lot of investors that we speak with is that a high ESG rating does not, it may, but doesn't necessarily mean that the company is helping the environment or society, and that it's managing its risk. But I always like to use the example of a company that produces clothes or textiles. They're at water risk. They use a lot of water in producing those materials. And they could reduce their water risk by reducing and conserving water in their processes and coming up with new technologies. They also could address their water risk by buying up the waterways to surrounding areas. And those have really different impacts, sort of looking outward on how the company affects the environment. And so we're always focused on ESG is about the company managing its risk, but not necessarily about the outward impact. But going back to the acronym, Jon, ESG has been sort of a political football in the last couple of years. And so some investors who might want to do investing that aligns with their values, how do you help them understand what are the potential legitimate concerns and what are the things that they can stop worrying about based on the headlines?
Yeah, my thought on that is that the types of clients interested in sustainable investing, I think, frankly, are not the types who are going to be persuaded by right-wing attacks on it, especially given the nature of those attacks and the form they've taken. In fact, their interest could be reinforced by it. So I don't think advisors should assume that client interest is sort of waning, or that's something they should necessarily shy away from now if they hadn't been before. I think the second thing is that one of the just sort of outright lies that may break through to the point of a client asking about it is that sustainable investing or ESG, whatever you want to call it here, is mainly about somehow forcing an ideological or political agenda on sort of defenseless companies, forcing them to spend money on extraneous things that cut into their profitability. So, I think it's totally very important to remind clients that sustainable investments are investments first and foremost. Their objective is to achieve, competitive risk-adjusted returns, and to do so to the extent possible by investing in companies that do right by their stakeholders and the environment. So, that's what this is about. It's not about the thing that the other side is sort of claiming it's about at all. I think also, another question that could break through and at least cause questions is this idea that it's a poorly performing way to invest. And I think that's been embraced. First of all, it's really never been true, but it's being used to suggest that, in particular, avoiding fossil fuels is going to lead to some kind of massive underperformance. And, the argument basically takes one single year, 2022, in which, traditional fossil fuel-based energy outperformed to supposedly prove the point. Not saying it quite so much this year, because in 2023, energy and utilities were the worst performing sectors by far. And all that being said, traditional energy only comprises about 4% of large cap indexes. So, no one is very heavily exposed to fossil fuels in terms of broad-based diversified equity funds. But anyway, the truth of the matter is that there are now about 650 funds, open-end ETFs in the United States that in some way, shape, or form, call themselves sustainable, ESG, responsible, whatever, across many different categories. I think across something like 75 different investment categories as defined by Morningstar. And if you look at how they fare against traditional funds in those categories, there is no underperformance. They perform on par, like the broader fund universe. Some sustainable funds are going to outperform, some are going to underperform. They're not all great performers, they're not all terrible performers. And when you look at, kind of the key category to a lot of investors, which is US large cap core, sustainable funds, again, they don't all use the exact, even in that particular category, they don't all use the same investment approach exactly. But last year, 30% of them finished in the top quartile of Morningstar's large cap blend category versus only 15% in the bottom quartile. And over the trailing 5 years, which includes that relatively poor 2022, 40% of sustainable funds finished in the top quartile of the large blend category versus only 12% in the bottom quartile. That's pretty good. That's actually outperformance. And so to suggest that somehow ESG, sustainable funds, whatever you call it, underperform is nonsense.
Emily, we've talked a lot about myth busting too. What are some of the ones you've seen and how do you address them?
I think Jon is right on the money here. It's about taking what sounds like a very broad, amorphous topic of ESG and making it tangible and clear. I find, first and foremost, the myth of, investors aren't really asking about it. There's a lot of headlines, but, not as much adoption. Our FlexShares team did a survey of high net worth individuals in 2021, and it essentially came back with about 72% of respondents said they were somewhat or very interested in a sustainable strategy in their portfolio, but 87% came back and said that their advisor had never raised the topic with them. I hear that all the time from advisors that I talk to in terms of how do I bring it up? Is it a potential landmine? What is the right way to do this? So I think the first piece here is just to recognize that there is a gap in the communication. However we need to sort of cross that hurdle because the appetite is there. But the other piece that Jon pointed out, I think is absolutely critical. The performance question, I think can be very handily solved by looking at specific examples of investment strategies. And there are a whole host of investment capabilities out there, many that have, 8, 10, 12-year track records, which are, a meaningful look back as you're thinking about, moving down this pathway. And so certainly looking at investment capabilities for the merits that they have, their investment performance over a certain track record, the type of due diligence that you as an advisor or an individual investor might do anyway on an investment portfolio, I think will handily solve for some of these more sort of amorphous concerns. If you leave it at it's a big tent and it covers a lot of ground, it's very easy to dismiss. Much harder to dismiss when you're talking about discrete investment capabilities that can chin the bar on performance and meet sustainability objectives.
Thanks. Jon, as the idea of sustainable investing has taken off, a lot of the mainstream firms have added ESG data to their funds or started funds that are in this realm. Can you go through a little bit like what you've seen as the trend and what you think is happening now and into the future?
Yeah, sure. I think first of all, it's important to point out that virtually all traditional asset managers, fund companies use ESG data. They have either ESG analysts who support portfolio managers, or they've trained their broader analyst teams to incorporate ESG. And so the use of ESG data and analysis is widespread in traditional investment strategies and funds. Ones that make no overt claim to being ESG funds. And in that way, I think actually ESG data and analytics are being used kind of as intended to help provide a more complete assessment of a company that can be gleaned from using financial statements alone. That being said, I think many older analysts and portfolio managers are skeptical about how useful ESG information is to decision making. And I think that's the case with a lot of financial advisors too. But I think as younger generations ascend to positions of greater influence within, asset managers and the wealth management industry, et cetera, they'll continue to use ESG data and analytics to help them make better decisions. And I think that'll drive improvements in this area in general, ESG data and holes and gaps in the data, that sort of thing. But your question had more to do with funds. And, the big traditional fund companies, they're always looking for new product ideas to add to their lineups, right? And ESG has really filled the bill for the past decade or so, maybe not quite that long. But, we've gone in the past decade from about 100 funds out of the 7,000 out there that have a responsible or sustainable mandate. Those were mostly from sustainable investment focused firms to today about 650 funds offered by a wide range of fund companies. 66 new funds last year alone, plus about I think 16 more that were repurposed funds that into a sustainability mandate. But, like happens with any new investment approach, the industry tends to kind of overbuild. So not all the funds are making it. We saw, I think, 45 sustainable funds liquidate last year, many of which are from these larger companies. And the reason was that they didn't have that many assets. They're the largest, I think, of all those closures only had 35 million in assets. So, ESG starts to be, if the company's not sort of committed to the idea, and it's just another one of many products in their fund lineup, and there's a sense that, this is something that's controversial now, whatever, they start to pull back on distribution and marketing, and kind of leave the impression that that the whole industry is starting to falter somehow, which just really isn't true. But I think that's like what we're seeing among a lot of traditional asset managers. They have other things other funds they would like to push now that they sense that ESG is a more controversial topic. So I think that's a trend we're seeing. The investors and advisors need to look at the fund company, the asset manager, to assess their credibility and commitment to this space.
That's a great segue into the next question, which is about greenwashing. So with so many new products available, or as Jon said, repurposed products, that means taking an existing product and changing it in some way, adding some ESG data considerations or a screen, which is excluding a certain industry to it. With so much of that out there, I found that it can become very confusing. And a lot of the language looks the same from firm to firm and product to product. So, Emily, how can people listening in understand what greenwashing is and then sort of sniff it out when they're looking for new funds?
It's definitely a hot topic. So in the US, we don't quite have yet any regulatory requirements around labeling or naming. So as we've already established, many of the players in the United States use different terms just because that is the state of play here. My expectation is that will change, and we are seeing that change in other markets. So for example, in the European Union, there's a regulation called SFDR, the Sustainable Finance Disclosure Rule. And this regulation essentially requires investment managers to categorize capabilities according to categories. So, category 8 has sustainability data included in it, alongside an investment return category 9, has more of a focus on sustainable outcomes, for example. And these rules have evolved a little bit. I think they're still kind of broad buckets per se, but they're a step down this pathway. We're starting to see investors in different jurisdictions ask us to speak in the language of those categories. So, would this investment capability be an 8 or a 9? How would you think about it? So we are starting to see investors and platforms that are running due diligence here looking for those touchstones, even though they're not available in the United States regulatory framework as of yet. In addition to being an investment manager that builds portfolios, we also have an open architecture platform, and we do traditional due diligence and ESG due diligence on third-party managers. So I'll give you a bit of an overview of our assessment framework and what we look for in managers. Essentially, we're going to have a sort of 4-step or 4-category assessment. The first thing that we're looking for is policies and procedures. So does the organization have a strong culture associated with sustainable investing? Do they have a policy that's publicly available? Have they made public commitments to certain standards or industry bodies? What are the sorts of resources that they have to bring to bear to really their bona fides from a sustainable investing perspective? The second is around their process. So, are sustainability or ESG issues, are data sets being considered and applied consistently in an investment process? Can you point to examples of where it features in decision making? What is the sort of data and information that the manager has access to? So we want to understand the resources in terms of the information and the resources in terms of the people. How long established is their team? Do they have dedicated team members? What are their credentials? The next step is really looking around their stewardship practices. So, are they transparent in how they approach proxy voting, how they approach engagement activities? Do they produce reporting across any of those functions from a stewardship perspective to a portfolio construction perspective? And we take these 4 different categories. We assess traditional due diligence metrics alongside these sustainability indicators, and we come up with a framework that essentially is an ESG 4 to an ESG 1. And a 1 is clearly an investment capability that has a robust, defensible process with good resources. A 4 is a manager that really hasn't, made a meaningful move in this direction and doesn't have, intentionality in their process. And so we categorize the investment capabilities on the platform through that framework.
We've got a lot of questions, which is great, coming in about how individual investors can sniff out the greenwashing. And so, Emily, it seems like Northern Trust has a very thorough process. But some of our participants are asking questions about how they can do it. And so let me offer a few thoughts here, and then you two can jump in if you like too. So one of the things is that a lot of the terms that firms can use are marketing terms, and they can define it how they like. So one of the early questions was around fossil fuel-free investing. And I think the woman who wrote in said she invested in a fund that looked like it was fossil fuel-free, but she found fossil fuels in it. And unfortunately, this is too common. And the way to discern it is in a couple ways. One is for example, Green Century defines it in the prospectus. And so that is that longer document, for people who aren't familiar, that's required to be filed with the SEC. In that, it does outline what the screens or exclusions are. granted, that takes a little bit more reading to do it. The other way to look is to look on the company's website and see how they define it. For example, there's another firm that offers quote unquote fossil fuel free products. But when you keep reading on that page, the way they define it is allowing up to 20% of their investments to be in fossil fuels. And so I find that to be very misleading in the sense of they're using that as the banner for their fund. So, but that is allowed under the naming rule. You can have a name and your strategy has to just follow a certain percentage of the investments follow that. The clearest and fastest way to see if your product is invested in fossil fuels is to look at the sector allocation. There's 13 sectors. You look under energy, and what you want to see there is 0%. If you see more than 0, it means it's in coal, oil, or gas. A related question, which usually comes up when we've talked about this, is like, well, what about renewable energy? And the tricky thing is, renewable energy shows up in different categories. So just because it's 0% in energy, that means sort of traditional or dirty energy, in our opinion. You could have renewable energy, whether it's solar or wind, in that fund or ETF or portfolio. And it will just show up. That's just the way things are categorized. So I hope that's helpful. One of the other questions is, people are asking about some of their ESG funds, and again, it's ESG funds, and they're seeing Facebook and Amazon in them. And should they be surprised to see that in an ESG fund? Emily or John, do you have a comment on that?
Well, I think this is a great example of, in this industry, we call it, we have the term greenwashing that we use, that, I don't know how often, sort of intentionally misleading practices or even maybe unintentionally misleading practices are actually out there. We've had a few instances of it, but I've tried to come up with another term like green letdown, or maybe just green fail to describe the disappointment that investors feel when the sustainable fund product that they've purchased doesn't actually do what they thought it was doing. And so, like you were saying, I mean, it's like about the only thing that you can do. I mean, certainly advisors should do this before recommending to their clients, but individuals as well, you have to look at the prospectus and all the materials out there that are about the fund and describing it. And if you don't have if that doesn't give you the information that you want, then move on. And the kind of the problem with that can be that there may be a lot of fund companies out there that you recognize the name and you recognize it as this is a legit fund company. I've had maybe their mutual funds before, so. But they could be the ones that don't really define this very precisely, or that have, 1 or 2 ESG funds out of a lineup of 200 funds. And if you can't find the information there, I think it's important to go to the more maybe smaller, more committed sustainable investment funds where they give you plenty of information, I think, to kind of make a decision based on what your expectations are. So, as far as Alphabet, Facebook, those are two companies that sustainable investors at least those who are focusing on ESG risks and trying to say, look, what we mean by ESG is that we're trying to invest in companies with low levels of ESG risks, maybe on the flip side, good ESG opportunities. Some think that Facebook and Alphabet have acceptable levels of ESG risk and therefore invest in them. Some don't. It's not a 100% in the industry. So that's another reason to take a look at the materials, and usually you can find the holdings as well. So I think that's important. I guess the other thing is, especially for advisors, but individuals as well, understand, I think, that funds are investments first and foremost. They're not tools of activism. You buy a fund because you want to achieve the benefit of appropriate risk-adjusted return. That's why you're investing. And the sustainability benefits that come with it, may improve the investment process and your actual returns by being focused on these risks and opportunities. But it also includes sort of ancillary benefits like encouraging companies to operate more in the interests of shareholders and in a more sustainable manner through stewardship and shareholder engagement. So, kind of keep in mind, these are not like perfect, not many of them are like perfect entities to convey your sustainability preferences, but you should be able to get fairly close by doing the homework ahead of time.
Mm-hmm. Well, let's talk a little bit about shareholder engagement. Our listeners may know what it is or may not. The quick overview, and then we'll dig into it, is that shareholder engagement is used now to discuss the broad range of a couple of different approaches in the firm. This is how Green Century defines it. The first bucket is proxy voting. People may know that companies issue an annual proxy statement. Many of the questions on that are about boards of directors or compensation or other governance matters. But shareholders like Green Century and others can also put questions to be voted upon by the shareholders. And so voting proxies is a way to express your reaction to those questions that are up there. We put the second bucket as shareholder engagement, and that is talking to a company or communicating to them in some way, either to get more information or to express your concerns. And so sometimes it's through a letter, many times it's through a meeting or a dialogue. Investors learn how a company might be addressing climate risk, for example, or treating its workforce. And then sometimes that's sufficient for that engagement or for that firm. Many times in our experience, if you're really trying to get a company to change a policy, you need to go to the third bucket, which is we call shareholder advocacy. And so that's a bit of an escalation where you're really pressing the company to make a change, and for us to do it on a timetable. So not just an aspirational statement like we'd like to source more renewable energy in the future. But more specific in that we will be sourcing more renewable energy. We're going to increase it by 25% by this date. Or we're going to get a toy company, which is the most plastic intensive industry in the world, to reduce its use of plastics in the next 5 years. And so those are the kinds of commitments that we are always seeking as a way to deliver sort of concrete action. But Jon, I remember you saying that you think shareholder activism is the untold story here. Can you elaborate on that for us?
Yeah, sure. I mean, I just don't think that many end investors, or maybe even many advisors, particularly those that just sort of recommend, ESG funds whenever they kind of happen to have a client that's interested in. I just don't think there's a broad realization of the scope and success of shareholder activism around sustainability and ESG issues, and that those investors are contributing to those efforts by investing their dollars in funds and with fund companies and asset managers who conduct those engagements. Many of these engagements lead to pretty important changes. I mean, I think Leslie, Green Century has been pretty exemplary in this area. They're getting companies to do things like develop climate transition plans, reduce plastic use, protect ecosystems and their sourcing of natural resources, and kind of the list goes on. Another example in another area, in 2020, after George Floyd's murder, so many public companies expressed support for racial equity, and so sustainable investors push them to divulge the racial composition of their workforces, which nearly all large companies now do. They didn't do it before, now they do, even ones that weren't directly engaged. And others were pushed to conduct racial equity audits, assessing the overall impact of their company policies and operations and products on people of color. And in some cases, those went to shareholder votes, and a majority of shareholders recommended that they do that. So, it just wasn't so long ago that companies weren't really very interested in sitting down with investors to talk about these things. And today, many more public companies are interested and are motivated to act. And I feel like they almost see these engagement efforts. Yeah, sure, sometimes they can be, the pressure can ramp up and it can get uncomfortable, but I think they want that information now, because they know that not only investors but other stakeholders are interested in these issues as well. And so I think that's one reason why nearly every public company today has internal ESG initiatives underway, like we mentioned earlier. And it just counts as a huge success for sustainable investment. So, once clients understand this and investors understand this, it just really resonates with them. In my experience, it gives them a really strong reason to invest this way and to stay the course over the long run.
That's what we always think, is that through the investing, through screening, you can do value alignment. Through using ESG data, you can reduce risk, maybe enhance performance. But if you want to actually deliver real world impact, you need to look for investment firms that are doing that shareholder advocacy, because that is what is very tangible for people. I know one of our listeners asked, is there a rating system around firms that do shareholder advocacy? I am not aware of one. I don't, Emily or John, have you seen that?
I would say there's some series sometimes puts out some information around voting activities. Share Action, which is a nonprofit out of the UK, also assesses investment managers around their voting practices. So there are a few frameworks out there. But if I could also just back up John's point, I think we're seeing a real growth in attention to stewardship just over the past 6 months to a year. And I think it's for the reasons that you both are describing. Investors are, perhaps were aware but weren't prepared to dig into stewardship previously. And today we get requests for information around how we vote and how we engage very regularly. And we produce an annual stewardship report, which is very regularly consumed. I started my career about 17 years ago at a small ESG data organization, and we were doing research and then calling companies. And the vast majority of the time, if someone picked up, they would hang up or transfer me to legal. Today, that's a totally different story. And one of the biggest shifts behind that story is because of large asset owners taking reports that, my company or other companies like that were producing at the time and asking for more disclosure. And this just echoes back to my earlier comments of the data sometimes is a bit Swiss cheese. A rising tide lifts all boats. So as investors that are attracted to the sustainable investing space, they're attracted to the space because they want to know what they own. And now they want to know more about what those companies are doing and how they're, working in their communities and amongst their peer groups and in other circumstances. And stewardship is an incredibly powerful tool. We've seen that play out over the past, 17, 20 years. I think we're going to continue to see a lot of attention on stewardship activities as a meaningful differentiator to how investment managers can be assessed and measured.
Right. Yeah, I think it makes all the difference in the world. I mean, last year, our shareholder advocacy team scored 20 policy changes with big companies, Costco, ADM, and Onward. Just recently, we got Disney to agree to assess, which, as Emily, as you're mentioning, disclosure is the first step. Assess how many plastics they're using across it, and then come up with a reduction plan. which is really, for us, the ultimate goal is to deal with the plastic pollution issue that's affecting our ocean wildlife and even ourselves. I do think that there is, in the last year or so, what we've seen is that companies, while they have more investment relations teams and manager teams that can meet with you, they're also become a little bit more emboldened about pushing back, given, I think they feel like they have some cover under the recent attacks on ESG, and they are challenging more resolutions with the SEC. In many cases, maybe winning this season. And then we'll see, as Exxon just took one of the filers to court, just challenging their right to file shareholder resolutions. So I'm hoping that other investors do not shy away from still bringing these concerns forward. And then I think for listeners, the way to assess it, since there is no tool exactly for you, is to read the impact reports and try to distinguish between what's activity and what's outcomes. The activity is important. So how many companies you talk to, how many proxies you vote, it's important because if you have more activity, it's more likely that you'll have more outcomes. But it's very common that engagements are described, but there's no necessarily an outcome to it. And so to have that real world impact, you want to be looking to see what is the policy change, what's the timetable, and then for us, we're starting also to report on, okay, well, we got a commitment 2 years ago from this company, and have they followed through? And what's the results of that? Because the headlines, you get the headline when you secure a victory, but you need to keep that pressure on as you follow up, because many companies do follow through, but some, in our experience, do not. And so that's why you need an active shareholder team to go and assess that and keep pushing. We just have a few minutes left. And so let's see if we can answer one or two more questions, but I also want to give both of you a time to reflect on, like, what do you think the future holds? So I am going to go through these and all right, we answered Jeffrey's question. We have, so if you're a individual and you are tuning in and you're not invested in any sustainable products yet, or ESG funds even, what's the first one or two things you would do? What tools might you use?
So I'm I'm biased to Morningstar since I spent so much time there. Morningstar's website has a lot of information about sustainable investing. There's in fact something that I did for quite a few years that my colleagues have now improved on immensely, called I think it's the Sustainable Funds Landscape Report that you can download. It's in PowerPoint form, and it's got a lot of great information on sustainable funds in the US. There are a number of, most large sort of do-it-yourself investment platforms have information on the funds that are available in their lineup. So you should be able to find stuff there. And then there's just a lot of, most of them are sort of, not too far from the startup phase of sort of online, robo investing sites and others that focus on this. So, a quick search would give you an ability to find quite a few of those choices. And then I would just start, checking them out and see if they're kind of answering your questions and offering you the information that you need. Mm-hmm.
There's a question about, would we recommend the As You Sow tool? And for those not familiar, they have a tool that helps you screen for different issues that you may care about. And We work closely with As You Sow on shareholder advocacy and on promoting fossil fuel investing. So we are biased in a way. I think the tool is a good starting point. It is a little bit of a blunt instrument. And so you can find, for example, fossil fuel free funds, but they may not be ESG funds. They might be just a health care sector fund, for example. And so I think it's almost a better tool if you have some funds in mind and you go and check them there. But if you ever find something that doesn't match up with what a fund is saying that they're doing, I would go back and check with the fund family. Go check the fund's materials and ask them why there might be a discrepancy there. We have found a few discrepancies for us and others along the way. So I think it's an okay starting place, though. I want to mention that we put out a guide on fossil fuel-free investing that's available through our website. So if people are interested, they can always go and download that. That's a good starter tool as well. Emily, though, if you're a financial advisor and you want to do more of this in your practice, but you're sort of the lone person in your firm, how do you help? What should an advisor do to promote it, to do more of it him or herself, and to spread it around?
Yeah, well, I think firstly, if you are an individual working with an advisor, ask your advisor questions. They don't know. And that was the result of our survey, is that advisors are hesitant and investors have appetite. The other side of that, if you're an advisor, how do you raise this? My question is, how do you not raise this topic? At the moment, Texas is experiencing the largest wildfire in the history of the state. All we need to do is talk about how bizarre the weather is right now. It is early May and it was in the 60s in New England over the weekend. I think there are a lot of very easy, natural ways that we start conversations around the topic of climate, the topic of environmental investing, just based off of headlines and in some ways, sort of chit chat, that you can start to take the temperature of your clients on how they how they respond to those topics. I think the other way to go about it is just to say, hey, we're remarking this trend in the industry. And it's an interesting topic. I'm curious how you are responding to that, or if you've heard of this. Certainly, I think Jon mentioned earlier the changing appetite of younger workers who are going into the investment management space. That's also happening for younger workers across industries, asking for more sustainable options in their retirement plans or in their personal investments. So as you're looking at investors who have multi-generations, that's another potential way of saying, how do we engage your children, for example, in this conversation? For advisors who are looking to sort of bone up on the topic themselves, there's a lot of information out there. We produce quite a bit of thought leadership. If you go to the Northern Trust website and look at sustainable investing, you'll find information around how we approach this space in our stewardship report, which I mentioned earlier. That's not unique to us. You see many investment managers that produce content in this way. There are a number of other organizations out there that produce information. Morningstar is a great resource. You could look at series. You could look at the Principles for Responsible Investing that produce a lot of information about how sustainable investing works. US SIF is another organization that produces a lot of information for advisors. There's also an uptick in certifications that are out there that individuals can go out and sign up for. The CFA Society has an ESG certificate. They've just launched a climate investing certificate. I believe USCIF has some educational programs.
They do.
I sit on the board of an organization called the Association of Climate Change Officers, which produces it's called the Climate Change Professional Certification. So there are a variety of opportunities to go out and find pre-packaged educational content that's web-based and easy to access. So it's almost hard to identify where to go because there's so much out there, but certainly it's available if you want it.
Right. USCIF also has a free course for individuals. It's an online course. I took it a few years ago to check it out. And if you're brand new, it's a great place to start. I noticed there's some individuals who are, wanting more in-depth information and really want to protect against greenwashing out there. I would also just contact the fund families. So you can just call Green Century and we will walk you through, show you where our screens are, go through what's in the fossil fuel free screens, the tobacco screens, factory farming is a screen on our balance fund. Explain what green bonds is to you if you're interested in fixed income investing and more like that. And just, it is IRA season. And I don't mean the federal policy and law that is funding more renewable energy. I mean the time of the year when you still have a little bit of time to make your 2023 contribution. And so this is a great time to do that. By April 17th in Massachusetts and April 15th generally. So if you're an individual thinking about it, this is when people are ready to answer the phones or respond to emails and do all of that. We just have just a few more minutes. Jon and Emily, I'm going to give you last chance to, in a minute or less, what do you see as the future of this, or what message do you want to leave our listeners with?
I can kick off. I think certainly talk about it. Start those conversations. Don't hesitate. It is worth the discussion. And I've been in this industry for 17 years. I have learned something new every day. It's a really exciting place to be. As I look ahead from here, climate change has been a real driver of the discussion. I think the next big driver here is going to be focusing in on what we call natural capital. So biodiversity, water stress, deforestation. I mentioned the Texas wildfires. That is going to be, in my mind, the next big driver of conversation.
Thanks. Jon?
Yeah, and speaking of which, the SEC is set to vote, I think, today on a rule requiring corporate disclosure of carbon emissions. So that's going to be in the news. It's likely to be litigated by Republican attorneys general. But it'll be important for advisors to understand and communicate the importance of emissions disclosure to investors. And I think it'll be on the minds of more investors to the extent that climate change hasn't been already. But I guess in terms of the sort of big picture, the trend to me is that, listen, there are more and more sustainability minded people out there who are becoming investors or who are becoming investment decision makers for institutions. There's also the generational transfer of wealth happening to those sustainability minded people. And it just means that demand is going to continue to increase for sustainable investments this year and on into the future. So any sense that this was like some kind of flash in the pan that's now been, ended because of criticism on the right of ESG, I think is not so.
Right. It's been around for decades and it's going to stay around and get stronger, I think. So thank you, everyone. Jon and Emily, thank you so much for your thoughts and contributions. I think it was a really interesting hour. Up on the screen here, you can see how to contact Green Century. I encourage you to call or email us with questions, especially if we couldn't get to your question today. There's a lot of more interesting things, and we'll be happy to respond to those. So at www.greencentury.com. And thank you again for joining us for the future of sustainable investing. Bye, everyone.